Good morning. This is Jim Riggio. Today is April 3rd, 2017, and this is the Monday Market Muse. Quick note before we get started. Capital Discussions is not a broker-dealer or investment advice. Presentation about C is for educational purposes only. We have no way of knowing your situation or knowing what level of risk is appropriate for you. We're not making any trade recommendations. The risk of trading options can be substantial. Please be aware of all risk prior to placing any trades. Any trades that we talk about, computer simulated trades are believed to be accurate. However, actual profits will vary due to such factors as liquidity, slippage, and commissions. Okay. I had done a full technical analysis review on um, the Vol Vantage weekly review. If you haven't seen that, I recorded it on April 1st. I think it didn't get posted until the 2nd. And I go through this in a lot of detail, but I'd like to make this be more interactive. We'll take a look at the SPX, SPY, and then we'll take a look at the Russell. Okay, I know that several people end up liking the Russell. I'll take a look at a comparison, and then we'll go in and take a look at the technicals. One of the things I wanted to end up just showing again, I haven't shown this, I guess, in a couple of weeks, was the following. We took a look at the overall long-term trends. You can see that when I draw these channels, okay, between the highs and the lows, you can see that many times channels will end up lasting for a year and a half to 8 or 9 years. You can end up seeing that after we hit the lows after the financial crisis, that we had basically just been driving up for nearly a decade. Yes, we did have this one period where we had some real volatility. The real volatility started in September, actually at the end of August of 2015, until we got through the pullbacks that we had in January and February of last year. And then we continued our march up. You can see how nice that the bottom channel was formed between the pullback that we had in Brexit, the pullback that we had during the U.S. elections, and basically what's happened here. As much as we've run up, we did talk, several weeks ago. I guess it's been more than a month now, when we talked about this blow off top. Okay, where we really ended up having this upward trend, and then we blew out of the top, and how usually that they don't last. They end up coming back in. You can end up seeing a few other places where we ended up having blow off tops, especially coming off of the bottom. Okay, when I end up taking a look at the longer term graphs, I end up also believing a lot more in. A lot of people use oscillators, or they'll use momentum factors, and we'll take a quick look at those. But what I end up believing, and I've seen work much better, is the actual battle lines drawn on the market, right, on the field of battle, if you will. Where are we end up moving? What does the trends end up looking like? What are specific price levels? Sometimes that end up being, real support or resistance. So if I end up taking a look, just so that you can see where these trend lines started from, I have to actually end up coming back and looking at this on a monthly basis. And Thinkorswim is going to be very slow. I have a lot of graphs open that I wanted to end up opening so that I didn't need to end up changing it very often. But if I end up taking a look at a monthly graph, you can see that a lot of the graphs I ended up starting to draw were from resistance lines, okay, or very bottoms that we ended up having. You can see from the very bottom here how this line ended up being support, and then it ended up being resistance, and that we could basically never break above. But I mean, this is a pretty steep, line, so it's difficult to end up sometimes keeping that level of momentum higher. If we end up going back to the daily chart over, say, just the last year, this will be a little bit quicker to see if I end up looking just over the last year. What you'll be able to end up seeing is that we did have some lines that were longer term that I left in blue. The shorter term lines I left in this magenta or this pink color. And everything was moving up, right? If I end up using the bottom from the election, okay, you can see here on 12/4 or the weekend before the election, how I ended up drawing that it was a support line on the bottom, how it ended up being a support line until we finally broke it. And once we did break it, we broke it in a big way. That's why I like to end up having support lines and trend lines drawn. I think it's very, very important. And, this I think is probably one of the best examples. This line that let's see if we can get it to highlight. It's there we go, and now it's in blue. You can end up seeing how it was a support line until when it broke, and then when it did break, it broke in a big way. And this day on the 21st of March was a rather significant pullback. I hadn't been able to draw anything better than resistance or price levels. You can end up seeing at 2277 we had a price level. You can end up seeing we had another price level at about 2300. Once we ended up breaking these, we ended up breaking them pretty much in a big way. Same thing up here, a little bit above 2350. We couldn't end up breaking, and let's just highlight. Okay, this year so far. You can see that 2350 line or just above it was a difficult line to end up getting through. Once we went through, boy, I mean, it was what a perfect example of something that ended up being resistance, and then ended up being support. And even when we ended up having that blow off top over here, and we came back we didn't end up breaking it. It wasn't until we ended up having the very, very big day of the 21st. Where we ended up breaking a lot of trend lines, a lot of support levels, and this was the first time that I was able to end up drawing any type of downward trend lines. They're rather new, so they're not as clean, but I did want to end up getting the bottoms tested here. You can end up seeing the lower level support of where we have our first trend line, down support line. We also have our first a resistance line above that we ended up having. It's not the cleanest line in the world, but we'll need more data points. But if we did hit a higher, a lower high here on Thursday, Friday of last week, it's going to end up just being a confirmation here that we have lower highs and lower lows. And this is over a month. This is the first time we've had lower highs and lower lows really since the election. And if I take out the news-driven pieces of the election and also Brexit before this, what you'll end up seeing is right here is the election. Okay, in November, here's Brexit, end of June. If I take out those two areas of I'm going to call it event risk, we really haven't seen lower highs and lower lows for almost a year at this point. And so the question is the bull finally getting tired? One of the things that ended up happening is that in a lot of different technical indicators, I'll end up taking a look at a lot of Ned Davis research stuff. It's institutional, so I know that you guys probably don't end up seeing that. But when I take a look at daily trading sentiment, just composite information about buying strength versus selling strength, we basically have been moving higher. Yeah, we've had our few times when we've ended up moving down, but basically for nearly a decade, since March of 2009, we've basically been in a pretty strong trend lined up. I don't see this changing, but what I do end up seeing, like we've had multiple times during the past decade, is that we move sideways to down for a while. The market's gotten perhaps a little bit in front of itself. The economy's still growing. The numbers are all still good. The job numbers are getting better. Salaries are getting stronger. Actually, salaries getting stronger. When you take a look at the payroll data, that ends up meaning that it's companies are paying more, which will hurt their bottom line somewhat. So they'll end up seeing somewhat of of an impact to their profit lines. But profits were last year were more expected to look at, they were still rebuilding. Okay, we're in a recovery, and so companies got a lot of passes, if you will, on their on their profit numbers. This year, they're expected to end up doing better. And with the economy that we're going, we're definitely getting better. But I think that with the so-called Trump rally, with expected lower taxes, with more infrastructure spending, if things don't happen as quickly and as grand a scale as the market was hoping, it'll end up showing that it was disappointed. If it's disappointed, it'll definitely end up pulling back. Will it end up being a pullback, okay, of 2008 proportions? No, I don't think we're anything close to that. But I do think that it's time for a rest, it appears. And at least we're getting those first symbols that will end up having a little bit higher volatility. Now, this makes it somewhat of a challenge. Okay, for a lot of us, I don't want to end up talking about this one. And the challenge is, are we going to end up finding a range in which we can end up trading? One of the things that I wanted to point out on this trend line, and you can see a very clean channel that we've had since the beginning of 2016. You can see the breakaway or the blow off top that we had, and that we ended up coming back in, and we've moved right back up to the trend line that we're moving to the top. If you take a look at the slope of the 20-day moving average, and these are simple moving averages, what you'll end up seeing is that we are been negative for the first time in months. When I take a look at the negativity that we ended up having, there was a lot of negativity in terms of how the 20-day moving average was looking going into the election. If you remember, these moves were very, they track the polls rather well. Okay, in fear of the so-called Trump pullback if he ended up winning. You can also end up seeing here, it was a little bit later, but the same type of thing happened with the Brexit vote. And just like with Brexit, even quicker, we ended up having this very quick recovery and a bounce. The last time we had any non-event risk pullback was really in this January, February timeframe. And you can see what happened to the 20-day moving average. And we not only was it resistance, but even when we tried to get above it, it wasn't until it actually proved that it was support and came off of it did we end up really coming at us. Do we have this level of pullback? I don't know, but what I can tell you is that we have started to see lower lows and lower highs, a little bit like we have here. I think that we're in a news-driven environment at this point where we're going to end up seeing things that actually do end up driving, stock prices either lower or higher. The fact that the market has been kind of increasing its expectations of how many times the Fed will end up increasing rates over the next year has also ended up bringing things down a fair bit. Okay, and so where does that end up leaving us? Let me put this one to the side, because what I'll do is that I'll start with the ruts right after this, and I'll use this same graph. When I take a look at things like oscillators, okay, you can end up seeing a couple of things. Here I'm looking at exponential moving averages. Remember, exponential moving averages use the closer to today, right? The more recent data, they weight exponentially more than the longer term data. So we're still looking at a 20-day moving average, but it's weighted using the nearer term dates. Here it's interesting that it really is looked at the 20-day exponential had acted as great support once we ended up breaking it on that faithful day a couple of weeks ago on March 21st. You can see it acted as resistance. We're trying to end up staying above it, but it's definitely losing ground. And you can see that the difference, as you could in the other graph with the simple moving averages, the distance between the 20-day, 50-day, 100-day, and 200-day, those are the four different lines you see here, right? 20-day is this green or bluish aqua color. Yellow is the 50-day. This orange is the 100, and the red is the 200. You can see that the distance between the lines is getting smaller, which means a lot of times, as we saw going into the election, we really didn't have anything that was a major pullback except for in that last week or so. It was really much more of a time consolidation moving to sideways. We also saw that from mid-December to the beginning of February, practically before we started to end up bouncing back up more significantly. The oscillators, again, we're looking at short term. So what you're seeing is that you're seeing a bounce coming off of the sell-off that didn't end up continuing down. But this is a healthier way for the market to actually get back some of the ground that it has, is to move down, okay, let the moving averages catch up, let the oscillators catch up, try to end up moving higher, make a lower high, and then do your next leg down. And that's what the market ended up seeing. I'll just show you that if you look at this on a monthly basis. Right, I'm going from daily to monthly. I'm skipping weekly. Normally, I'll end up doing it in stages, but because Thinkorswim is rather slow today, I'm not going to end up. What you can end up seeing here is that on a monthly basis, things look to be fine, and we have two little, red bars. Okay, in the last 2 months. We're still very near our high, so in the longer term, it doesn't even look like it's affecting us in any way, shape, or form. Our moving averages now, instead of being 20-day, now they're 20-month. Okay, if you take a look at, and then it's 50-month, and so in a longer term view, there really isn't much here that we need to end up thinking or being worried about. When I take a look at more of the momentum factors, okay, what you're looking at here is a linear regression channel, which has obviously been very bullish over the last, several years. You can end up seeing that the pullbacks that we ended up having for Brexit and for the election were basically, the election came right down to our lower 100% lower regression channel line. Don't forget, if you take a look at the futures were way down here that evening, right? But we bounced right back up. So while the market was open, we don't even see that. You can also end up seeing, okay, the red and green lines, okay, that are more curved here. These are the Bollinger Bands. Many times the Bollinger Bands will end up getting narrow when we're moving sideways. Volatility kind of contracts. And then once we have a breakout, whether it be up or down, the Bollinger Bands will widen out. And then as things start to end up calming down again, you can see that they were starting to try to get calmer as we were moving into sideways consolidation. And then again, it's this March 21st day that starts to make the Bollinger Bands end up getting wider. Remember, the blue line in the center of the Bollinger Bands is the 20-day moving average. So you can end up seeing here that is the 20-day now acting as resistance, okay, with this lower low and lower high. The fact that we ended up hitting the 20-day, again, all of these things are not very positive for the short run. For the long run, I don't think it makes much of a difference. That will move sideways to downwards. We don't have, for the long run, we need to see more evidence that the trend down is forming. However, okay, and this is a big however, and that's a huge if the markets do end up starting to pull back, all of the pundits will come back and show these early warning signs that the market has started a reversal. The question is, how severe will this reversal be? Will we move sideways for the next month or two, or could we end up being in a possible larger pullback? Okay, that's really what I wanted to end up showing. I'll end up going through and taking a look at some of the individual, and let's take a look at some of this stuff over here. I wanted to start to take a look at the Russell. Okay, a lot of people I know trade the Russell. Few of you may trade the NASDAQ. I don't know if Curtis, if you're out there, I know that Curtis and the Eagles guys end up looking at the NASDAQ sometimes. So this chart is a shorter term chart, and I purposefully have it pretty much from the beginning of the year. Right? I'm only looking at 3 months. The bar chart, or the candle charts, I should say, is the S&P. Okay. The yellow line on the bottom is the Russell. The white line on the top is the NASDAQ. So while the Russell has moved dramatically more and had much better performance coming off the bottom after the elections, what has happened is that over the last 3 months, it's underperformed, and it went from a leadership role to a laggard's role. And the NASDAQ, okay, has really taken a leadership role. And so the thing is, we take a look and see, well, what industries, okay, are driving. So we definitely see a size, okay, issue that the Nasdaq, okay, it used to end up being small caps, but no more. It's right. You know, those largest caps are there with Intel and Amazon and others. And so we end up taking a look at the Nasdaq 100 and its race up higher. And so let's take a look and try to peel back the onion and see where that's coming from. Okay. Oh, before I go there, I just want to show you a longer term graph, right? This is a 6 month graph, including the election. And so here was the strength that we were talking about with the Russell. If you take a look at right after the election, what ended up happening with the Russell just was on fire and ended up having this huge run higher. And it was by far, okay, the leader, because look at where it started from. The NASDAQ continued to end up, okay, basically tracking at a lower rate, but was tracking definitely below the S&P 500 until the new year. And you can see what happened from the new year going forward. And you saw that in the last graph, that the Nasdaq really has made just great strides where the Russell's kind of moved sideways. Granted, in a pretty wide range, but it's moved rather slow, or it's been rather volatile in the short term. In the longer term, it just doesn't seem to be moving any place. Okay. What I wanted you to see on this one, and this is your cheat sheet. Let's move this over here again, a little bit lower. Okay. What I wanted you to see here is energy has not been able to end up holding up. And again, I'm looking over the last 3 months. Okay, it has continued to end up falling. The price of oil and everything, it's broken away. When oil breaks away, I can never get 2007, 2008 out of my mind. Oil ended up hitting its high, okay, going into the financial crisis, and then got absolutely crushed. To me, the two things that are signs that the market's getting jittery is when oil is kind of like it's the lost soul. It is just way off. It's not tracking anything close to anything else, and that's been happening now for a while. I do realize it's a different industry, but you do like to see if the economy is recovering. You would like to see the oil sector or the energy sector move with the rest of the market. That hasn't been happening. The other thing was that financials had been leading the markets, and you can end up seeing that in the white line over here. And what's happened over the last month or so is that financials have not ended up holding up with the market. These are two signs when you start to end up having divergence and a shift in leadership. Uh, it's somewhat of a concern. However, okay, on the very positive side, if you end up taking a look at this line up here, and sorry, I guess once I highlighted that, when I take a look at this line over here, with this light green line, what we're looking at is that we're looking at technology. And when technology leads, that's usually a very positive sign. It means that companies are willing to end up investing in their future in terms of their automation, okay, and keeping their technology up so it makes them better able to compete. And so when technology spending picks up, it's usually fortuitous for the market. In the sense that we looked at it, it's probably a bullish sign. So we're getting some mixed signals here, and I think that what we've seen, okay, over the last couple of weeks, and there was a really good Ned Davis report that ended up talking about how the rapid rotation that we were seeing from different industry sectors and how quickly things were moving back and forth, sometimes even on a daily basis, shows that the market's jittery. And that means that when the market gets jittery like this, it gets primed for if bad news does hit, the selling is going to be pretty swift. Okay. Um, And let's go and start to take a look at Russell, because some people ended up asking. Let me get rid of this. Oh, this is just a longer term view. I wanted you guys to end up seeing this. This was financials, and you can see what happened was that after the elections, it was financials that really, really took off. And so some people saying, oh, it's just giving back a little bit of its gain. It's still in a leadership position. Yeah, it is, unless it keeps pulling back, and then people end up pointing, oh, this was the start of it pulling back. And so what we're seeing here is that the financials are really driving a lot of. You can end up seeing that technology, again, this lighter green line where I'm pointing to right now, that it moved pretty much sideways. It lost a little bit of ground to the S&P 500 after the election, but starting from the point where I'm showing beginning of December last year, kind of found its footing and has been on the slow but very steady pace higher, outperforming others. You can also end up seeing things like utilities, okay, here in yellow, that are very interest rate sensitive, had end up lagging as interest rates start to end up moving up. And there was some things it's trying to end up making its way back. So again, here we're just seeing a lot of movement from one industry to another. Okay, and what I want to do is I want to get rid of that one. And let's come, first of all, let's make sure that this one's gone. It's not gone yet. Okay, so here we go. Let's take a look at what's been going on with the rut. Okay, I want to make sure that I don't, let me get rid of all of these drawings. Okay. Have to end up waiting. Sorry, Thinkorswim is just being not cooperative right now. Okay, they're almost gone. As soon as this little box finishes coming down, and I can say okay. Um, what you see here, again, if I take a look at the moving averages, in some ways, the moving averages are more damning to the Russell. In a lot of ways, they're more damning to the Russell than they are to the S&P. And it's still not. Okay, they should be gone. You can do it, Thinkorswim. You can see that the 20-day moving average here in the blue line has definitely ended up coming down. We did break above it, so that we ended up having more of a bounce after the 21st that we ended up having, moving higher. You can see that the 50-day, okay, had been a lot closer. The 50-day and the 20-day had touched here. Great point of showing support that we're moving higher. It did break below, okay, rather substantially, and so it's been more of a challenge right now. And so what we're seeing on the Russell compared to the S&P, you see a lot more volatility. So it's moving all over the place. When I end up taking a look at the Russell, I still have, and let's take a look at from mid-December to now. Okay, you can still see that we have lower lows, right, lower lows and lower highs. The lines aren't as clean. Never expect them to be as clean in the Russell, but it's definitely a sideways consolidation that we've had for a much longer period of time. If you take a look at how the S&P since early December had continued to move up until our recent battle with the lower lows and lower highs, the Russell's moved more sideways. And what's happened is that if you take a look at the ranges that we ended up having back in December, you can see that our ranges have ranged a little bit higher and a little bit lower. And so when you start to get greater ranges like that, it's more concerning, because what ends up happening is that means that when the market does finally end up moving in one direction or another, it can end up really moving. Will the 20-day hold here? That would be, very important. If we could get the 20-day to end up starting to move on a positive slope. Right now, it's obviously a negative slope here. We're trying to flatten out the exponential. Okay, we're only looking at simple. The exponential moving averages would be better because what they would end up showing is a greater weight to the 3 days that are above. Okay, than they would, some of the dates that were, further back. So where we end up standing is it is definitely, I think a bit of a challenge for the Russell. The fact that it ends up moving the way it has is been there's not a question that it's going to end up being more of a challenge for the Russell. Let me pull up the linear regression channel for them. Okay. So in the linear regression channels, you see the same type of pullback that we saw with Brexit, with the elections, the sideways moves, the center linear regression acting as really good support, the Bollinger Bands being very tight, as I had mentioned, okay, that they would get wide when you had large movements, like after the election. But really, from this point on, right, from early December, what you can see is the Bollinger Bands getting much, much narrower and then staying narrower, getting a little bit wider at this point because we started to see a little bit more movement up, a little bit more movement out. So my Bollinger Bands have gotten wider. When Bollinger Bands get wide like this, it's usually a sign that the market has just moved and its propensity to move in the future, either a strong recovery from or a counter trend from its initial move or a continuation ends up happening. So when you take a look at, for example, how we came back from the election and how wide the Bollinger Bands got here, we pulled back. We pulled back almost to the 20-day. We pulled back to the center of the linear regression, only to end up bouncing and then going up again. And so the challenge with the Russell that I always see is that yes, you get a lot more implied volatility, okay, in the Russell than you do in the S&P. And the Russell can end up moving much more. It can move much more. It can move in a straight line, meaning like after the election, how its run up was much more as a much greater percentage than the S&P, and you can also get more daily volatility or noise, as we've seen over the last month. Right, we've had more up and down movement in the Russell, and so if you're going to end up trading it, a lot of traders like that. Okay, because it'll end up giving you greater opportunities to pick your um, um, pivot points or your points of inflection when it ends up moving up or down and you think it's going to end up finding support or resistance. Um, so it's to me, it's more it's there's greater risk here because of how far it can end up moving. I know I'm being paid a lot more for my options, um, but I didn't trade. I don't trade the Russell nearly as much anymore. Um, do I put trades on in the Russell? Yeah, I do. But usually, what I do in the Russell is that I keep very, very, very tight um, butterflies. I can end up showing you. Do I have it here? No, I don't. I don't have it up. I thought I might be able to show you. I guess I can show you this. I had adjusted this a bunch of different times, so I'll show you from because its numbers aren't there. Sorry, I think this image is so slow. Okay, and if we can end up just getting this so that it actually shows what it should show. I'll end up trading irons. Okay, and the reason why I'll trade irons is, and I'll keep them very narrow, is when I take a look at this for a risk of $5,000. Okay, that's what I could possibly lose on this butterfly. It's an iron. I've brought in a little over $37,000 in cash. Now, I'm using some of it, okay, because I wanted to be long a few individual stocks. And so it's a way for me not to pay interest to Thinkorswim, right? It's a I go to the church of I don't like to pay margin interest, okay, at the obscene rates that some people end up charging you. And I never negotiated any rates with Thinkorswim because I figured out why bother, okay? I'd rather get lower commissions. What I'll do is I'll just throw on some really narrow butterflies, okay, bring in cash and then use that cash to end up trading. And so this is done rather well. In serving its purpose. My year to date on this entire Russell trade is up about $800. And so it's really not a trade that I'm looking to end up making money for as much as I'd like to be able to have it be slightly positive. Okay, not a big deal, but slightly positive. But much more importantly, I end up using it so that I don't have to end up paying any margin interest. Okay. So that was the trade that I think. Yeah, the problem is when I take a look at Thinker, some people saying, problems with Thinkorswim. I never used to have problems with Thinkorswim. Recently, meaning over the last couple of years, its performance has just gotten worse and worse and worse to the point where I keep two separate machines. One I'll do monitoring on, and the other one I have to run nothing but Thinkorswim with no graphs, no anything, base basic everything, so that it's quicker because it's the only way that you can end up trading, right? You can't trade, okay, and have the market be as slow or your system be as slow as I just showed you. Okay. Let's go through a couple of other quick things, and then what I want to do is I want to visit our leap diagonal trade. We haven't visited that in a few weeks. First thing I want to end up visiting is I want to take a look at what's been going on with the Volvantage trade, but not just the trade, what's been going on overall with the market. What you're looking at in this graph is a 15-minute chart of the VIX with the candles on the bottom. And then each of these lines going up is the VX futures. You can see that this dark blue line ended right here. And the reason why it ended right here was that this was on the day that the March VX futures expired. You can see the blue line over here. It says VXH7. The H means March, and the 7 is 2017. And so you can see that the next line over here is VXJ7, the aqua line. J is April, right? VXK7, K is May. You can see in the M over here, M is June. And so VXM7 is June. And it just goes on, right? Then the N7 is July, and the red is August. And one of the things that you like to end up seeing on a trending line like this, in terms of what's going on with the market, is that you like to see the shorter term the shorter term futures. In our case, the front month at this point is April. You like to see that falling off at a greater rate, like you did here, like you did here. You can see how the blue line, or the lighter blue, or the aqua color line, is falling off at a faster rate than the green line, which is the month after it, which is falling off at a faster rate than the yellow line, which is the month after that. So I'm taking a look at how much April is falling in the aqua line, the green line is May, and then the yellow line over here again in the M is the June. So you can see that this looks very, very normal. Now remember, expiration or settlement date for the futures was on the Wednesday morning after normal expiration. And normal expiration, you can see here, is 317. This is because I'm looking at the VIX. If I actually put in the VIX futures here, the continuous contracts, which is the VX, what you'd end up seeing once Thinkorswim comes back is that the expiration date was actually on the Wednesday morning afterwards. And this dotted green line here, can you see that right here? you can see that to the right of it, this is when the K7, and you can see that right here, when the K7 became the active contract. And what ended up happening was is that the H7 fell off, and that's why you don't see the blue line movement anymore. Now, here's what had concerned me. These few days, and you do end up having a lot of noise sometimes going into and out of expiration. A lot of large institutions are doing their rolls, and so they're much more jittery. They're much more jittery. Usually coming out of an expiration. Now remember, usually expirations 2 out of every 3 months, 2 out of every 3 months in a quarter. The normal equity expirations, third Friday of the month, happens after the VIX futures. The VIX futures are usually 2 out of 3 times are expire on the Wednesday morning before expiration. That we think about expiration, third Friday of the month. On the last quarter, on the last month of the quarter, meaning in March, in June, and so on, expiration for the VIX futures happens a couple of days after our normal expiration. And that's what happened here in March. And so on these days, right, on these 2 days, the Monday and Tuesday after expiration in March and June, you tend to see more noise. Okay, and so when I saw this more noise here, I didn't see a lot of noise on the second to last day. It kind of flattened out a little bit. I saw noise on the first day, and then usually what ends up happening after that, this starts to end up coming down again. And we moved sideways. Then we moved higher, and then we actually ended up getting close to touching the next month. And then it's like, okay, well, maybe that was just the sell-off caused by the whole, U.S. Congress vote, not vote. Yes, we are going to vote on Obamacare. And when the Republicans couldn't even get a vote going, that uncertainty seemed to pass, and it was like, okay, things ended up seeming to be normal again. And we have this nice drifting down where the front months are drifting down more than the longer months, and everything, okay, is copacetic, and everybody should be happy, and we're back to normal. But that didn't happen. It happened for a couple of days, then we started to move sideways, and we started to end up moving up. And so when I ended up doing the Vol Vantage review of the trade, I end up talking about, this to me is a big challenge. And the fact that we're seeing this happen here, okay, where the shorter term, and in this case, what we're looking at is the VX. Remember, the front month VX contracts are the April. The green, you can see the green right here is K, right? VX, K7. K means May, so that the April is getting closer to the May, and May is getting a little bit closer, okay, to June, and this is concern. To me, one of the first places you'll ever see the institutional footprints of the big boys being scared is in this contango backwardation analysis when I look at the different futures. This is probably the one of the most important. I know that when I've taken a look at how much money some of the high frequency trading firms pay to the different exchanges in commissions and fees, that usually VIX and VIX-based products are going to be which ones they pay the most commissions and fees to, which makes perfect sense because since it's the lowest price index between the futures and the options, it's the one where they can end up and it's the one that will move the most. It's the one where they can get the greatest return on their capital. Yes, they have more risk, but because they are as fast as they are and because of the institutional nature of their algorithms that they end up using, their fast computers, their fast networks, they can tend to move a lot faster than either you or I. But here's one thing that they can't do, right? They can't hide their footprints. Okay. One of the things that I end up saying often is you need to take a look at elephants leave footprints. There's no way these guys can do the amount of volume that they're going to end up doing and not end up showing their hand in the marketplace. I can go and show you volume, and usually, and that's what I'll do. I'll look at volume a lot. One of the challenges, volume's harder to end up reading as much as it used to be. Paul Demers ended up showing how he ended up having, another package. Thinkorswim will end up showing you volume. I've done tape reading on how to look at individual stocks or things like the ES mini futures for the S&P 500 or the SPY, and you can end up seeing some of that. Right, you can see some of that, but you can only see it on a 1 minute basis. But it's confirming, okay, what I've seen here is that there are definitely some days where the bulls just run all over the bears. But the Bears have been standing up more days than not over the last couple of months. It used to be the only thing I'd end up reading. Okay, in the people would say, "What do I see in the tea leaves?" Right? Tea leaves meant when I'm looking at the tape and I'm looking at the volume numbers, I'm looking at the futures, I'm looking at the VIX futures. The only thing I used to ever see in the tea leaves was the bulls' hoof prints on the bears' heads. Now the Bears are starting to fight back a little bit. Is this just a minor, okay, battle that they may end up winning sideways? The answer is I don't know. I don't think it's going to end up being anything bigger, but it's definitely the place where you'll see things happen first. Using a 15-minute chart, you can definitely see that the shorter-term futures are moving higher. To me, this is a really important one. Any questions on how to take a look at the VIX futures, because I think that that's probably, like I said, that's probably the number one place I'd go to look to read tea leaves in market direction. Okay. Now, so let's go and take a look at our SPY. Let me get rid of these. Just another chart on the SPX where I actually showed the chart of the lower low and the lower high. I think in the channel it was easy to see. We had a breakout, so I'm going to have to definitely draw a new channel. But the new channel might be able to end up coming back to here, which would be even better, right? Because now I would end up being from the very top. I could end up seeing lower highs going forward. So I'll redraw that for you next week. And let's go to here. And again, this is probably not the. Yeah, let's. This is the better one. Okay. So let me first end up. Since I already have this one here and I don't have anything, so let me show you this one because this will just be the daily one that we end up having. And our current position is that we still own our two December 2018 puts at 220 on the S&P. If you remember, those of you who haven't been following, the trade, the leap diagonal trade that I put on was it was a way to end up learning how to do calendars in a relatively safe manner. And the way we ended up doing this is that I choose an anchor strike that's going to end up being some type of a leap. What we ended up doing is that we ended up choosing 220, and we chose the 2018. Let's talk about how far out we end up having, because that's actually more important. Because 1 and 2 year implied volatility was at a multi-year low. We thought, let's buy the long-term puts closer to the money. It was a little bit below the money. And the concept would be for us to roll the front months every single month and try to end up taking the fact that the short-term options expire or lose value at a much more rapid pace than the back month options. Now, the risk, right, because every trade has risk and reward, there are trade-offs. The risk in doing that was that if the market moves very far from my strikes, I do have a bit of a challenge. okay, where I'm going to have to end up dealing with what's going on with the amount of delta risk that I have when the market ends up moving. Now, the delta risk is minor in my opinion because I don't care. It's just a longer term trade. I don't care if it moves a little bit. I care how quickly that delta can end up hurting me. And obviously, that means gamma, right? Gamma is the change in delta. Here's what that means, okay, without using any Greeks or any math. It means that if we move further away from the money, that's where my risk is. If we move closer, if we stay closer to the money, or in this case, let me be specific, closer to our short strikes, which happen to be closer to the money, we'll end up making more money. Now, we'll collect money every single day, right? Because every single day, this magenta or pink line gets closer to this light blue line, right? Every single day, as we get closer to the expiration, the market's falling off a little bit. I don't know if you guys need to do anything. As we get closer to expiration, what ends up happening is that our T plus zero line will morph, getting closer to, right, the pink line will get closer to the blue line. Now, when we take a look at that, here are a couple of very, very important facts. It doesn't move there uniformly. It's not like every single option, okay, theta will end up being exactly what it says every single day. What ends up happening is that when you have pullbacks, okay, like we're having today, and the market moves, pretty quickly, what ends up happening is that the VIX might pop up, but it doesn't pop up uniformly on every single strike. It may end up moving up closer, or it may end up moving up a lot more for the options that are closer to the money than they are further away. Everything works off of a percentage, and this is skew. And I don't want to get into all of that. I just want to end up kind of taking a look at where we are on our trade right now and what our plan is. Now, our expiration, and let's come over to here. Let's make I don't think let me see if I can close anything else. I'm trying to close one other window. Okay. So let me hide my positions and just look at just the trades that we've done. I also have it, by the way, Thinkorswim Solaria. I also have it on a 3-second delay for quotes. Okay, let me come over there. Take a look at what our expiration graph looks like. This is just all Thinkorswim. Sorry, guys. Okay, as soon as it comes, you'll see the expiration graph come, hopefully. Okay, so here's what our graph looks like. Okay, in our trade, do I have? And I don't have all the final ones in here. I have to end up actually. So what I did was I used a different setup with my graphs. This one was supposedly used less strikes, and so that I thought it would end up being faster. Obviously, I was wrong. And what I want to do is I want to be able to end up showing you what our trades are. The way I end up doing this is I end up keeping my prices, and I look at prices, and I will end up exporting all of my trades to a file. And when I end up exporting them, I can then re-import them at any point. So this one happened to be an older setup on Thinkorswim trade that I had. So I can go and I can end up importing the trades when I've exported them. And I have gotten them to here, and I have an SPY trade that the last time I saved it was. That's where it is. We haven't traded it since the 17th, so I should be fine. Okay. The way I end up and this is the one that I'd want to end up showing you. So the way I end up keeping this is that I adjust my price for whenever I do a roll, I take my P&L that I made and I end up adjusting my price that I ended up paying for these December 2018 puts. I then end up keeping where my singles are and what I've done and where I've kept different trades. And so one of the things that I can end up seeing here is I'll take a look at what I've done and where I've kept the initial trade. Originally, we had two short strikes at 22.30. I did end up I'm sorry, I'm doing that again. In SPX, I should be talking SPY. In 2.33, I had my two short strikes. I did roll one of them up a point to 2.34 when we moved higher. And so this is what we end up looking like with this implied volatility. Now, with the market moving up like this is great because what ends up happening is it drives implied volatility higher and it helps our roll. Now, normally what you'll end up seeing is that on a day like today, my S&P position, it's actually down $13. And I said it was great. Why is losing $13 great on a day like today? Because what ends up happening is that, yes, the April implied volatility has moved up a little bit, but the May has also moved up. And when May moves up, it doesn't have to move up nearly as much. Let me end up showing you, and this will be the last thing we do. Let me end up showing you the Aprils versus the Mays here. Okay. And come on, Thinkorswim, please do this for me. Okay. I'm only looking at 20 strikes. So here are my two short strikes. I hit it twice, and then hopefully. So my two short strikes are 233 and 234. And you can end up seeing the Vega here is 21, right? 21 and 20, okay, for these two. Now, the front month's definitely going to end up jumping more. There's no question about it. There's only 8 days. So what we'll do is that we'll see this move much, much, much faster. And we just got executed on another trade. And so what I want to end up doing is that now would be a good time to end up taking a look and seeing, could we end up doing a roll to take our short strikes and move them out a month? I'll take a look at how much these things are trading. Remember, if they finish out of the money, they go down to zero. So we have a lot of value left in these two. Okay. And so does it end up moving for us and beneficial? Let's take a look and see what ends up happening with the Mays. I'll go and I'll take a look at how much diagonals will end up costing me. I won't look at verticals anymore. I'll only look at diagonals. And what I'll take a look and see is how much I can end up getting for closing our Aprils and rolling them into May. Thinkorswim's too slow for me to do the analysis right now. I'm going to have to end up shutting it down and bringing it down with a much smaller screen size. And I'll see if I can end up doing that. I would have liked to have done this with you, but Thinkorswim is just not cooperating today. So I can't end up doing the analysis when we're moving this slow. I'm going to have to shut down the whole thing. But what I would end up looking to do is saying, I start with, let's say, a strike. Maybe I'll choose a strike at 231, and I'll take a look at how much it'll end up costing, or how much we'll be able to collect to close our 233 in April and roll it to a 231 in May. Then I'll take a look at saying same thing. I'll take a look at closing it and rolling it to a 232. I'll look at closing the 233 and rolling it to a 233 again in May. And so in May, I'll keep taking a look at, and I'll look at maybe about $5. Because the 220 is significantly below the money, the 220 is the long option, I will look basically at and below the current price for maybe about a $5 range. If we were much closer to the money with our long, then I wouldn't be looking completely below the money. I'd be looking maybe $2 above to $3 below. Okay. If we were above the money, meant that we were in the money, then I'd have to end up changing. I'd end up looking to change the strikes and have them either all above the money. Now, when do I do the roll of the back month? Because I put this thing on some time ago and we've moved up dramatically since I put on the 220. I don't worry about rolling the 220 leap higher if the market's moving up, unless we move up substantially. We get more than 10, 15% away from my short strike. I mean my long strike. Then when I'm selling, it's a little bit more challenging. I do like being further below the money because it means that I can sell my front month options, the front month puts, below the money versus above the money. And if I'm selling them below the money, I'm getting a higher implied volatility. So it's actually a good thing to end up being, maybe 5% below the money. Okay, 2 to say 6 or 7% below the money is more ideal for that long strike. But you can end up, you don't have to move it very often. And so, if I have to move it maybe twice a year, okay, is what I'm hoping for. I'm hoping for not at all, okay, but twice a year is still plenty acceptable. And so I'll take a look at rolling these things. And with the volatility popping up a little bit, we really haven't moved that much. The VIX futures have moved up a half a point in the front month. The second month's only moved up moved up a 0.16. So it hasn't moved that much. And so we're still at the close to the money. We still have 2.5 weeks left to go. So there's no need to have to end up adjusting right now. I'd like to see more of the money come out of these front months. When I take a look at the theta, right, you can see that I have 5 cents of theta in the front month. When I look at the second month, if I do a roll, I'm looking at 4 cents below the money. So I'm not giving. I'm sorry, I'm right here. I was pointing to the wrong column. I'm giving up about 4 cents. So I'm giving up a penny of theta. It's not a lot, and this has to end up doing with the term structure. If the front month, okay, comes down a little bit, meaning it's in its implied volatility, we'll end up losing more money in that front month than we would in the back month. So letting this thing end up running out, settling out a little bit, having some time go by, maybe doing a roll later on would end up being more preferable. What's the most preferable? Oh, what most preferable is to have, be able to end up rolling on the Thursday or Friday of expiration week, because then you have very little time premium left in these options at all. And then when we do the roll, we don't have to end up paying the $1.37 or the $1.69 for this. We'll end up paying very little for them, because there'll be no time premium left in them, and then we'll get the full amount that we end up collecting in the back month. What's the challenge? If it runs away from these 2 strikes, then we end up collecting a lot less, because we're going to be selling options that are much further away from the money. That's the methodology behind taking a look at doing the rolls. I will take a closer look. I'm probably not going to end up doing anything today. If I do, I will send out a meeting notice. I have not ended up setting up everything that I need to set up in the classes, but just let me show you. Within the next week or so, when you take a look, you can end up going to the Capital Discussions classes page, take a look, and they'll end up being a free leap diagonal trade. And we'll end up having I'll have this all updated. Here are the messages that I've sent out so far before March. I was sending them out in emails, okay, and just posting. Going forward, I'll end up having this a lot better. I'll have all of the history in here. The challenge that we end up, Tom and I have with the history is that We had done everything with a single trade before, right? The Kevlar, the Road Trip, the Fruit Fly, the Weirdo, right? They were all trades that you ran for a month and you end up closing. Here, how do I'm not going to be closing that back month. And so it's more difficult for us to end up showing you what's open, what our open P&L is, because the thing is we have some things that are closed and it's going to be open for pretty much, the entire year. So we need to end up figuring that out to make it a little bit cleaner for you to be able to end up viewing. But I'll definitely send out the message as soon as I do any adjustments. Any questions on this? Okay. Um, the St. Petersburg blast, I'll leave you with this. Okay, somebody said, "Oh, I guess the St. Petersburg blast is there was a they don't know, right? They think it's a terrorist attack in St. Petersburg on the subway." By the way, my wife and I and my daughter were in St. Petersburg this past summer. We thought it was absolutely beautiful. We felt very, very safe. Have a neighbor who's Ukrainian, who we were talking about St. Petersburg last night, and about just everything that's going on in the Russian government. Is it a concern? Yeah, it is. But the problem is that the same it happened at around 8:30 or 8 o'clock in the morning. Our time is when I heard it on Bloomberg News, and so we started to sell off well after that. So it's not this move isn't from the at least the initial blast. If there's follow up stuff, and I haven't been looking at the news for the last hour. If there's follow up or if there are further threats, they could be. But just from the first blown up subway car. I don't think that that's moving, our markets to this level. Um, what I've also ended up doing, and the reason why I wanted to end up ending on that was that what I found is for us to speculate what's driving a market up or down is probably the biggest exercise in futility that I've ever seen in my entire life. One of the things that had helped me dramatically is when I shut off CNBC and Bloomberg and I stopped looking at the news and all I did was focus on what was going on in the market, how volatility was moving, how the put skew smile was changing, how the term structure in the SPX and the SPY options were changing, what was going on with the VIX futures. By looking at the actual market, okay, I can end up seeing and knowing, when to end up. Oh, this one's really moving. Okay, is this one moving really fast? No, it's kind of a controlled sell-off. Okay, volatility is moving up. There's no question about it. Our technicals are all in line here. That this is what we end up kind of expecting. So there's nothing really to be, for me to end up jumping for right now in terms of afraid that the market is just going to end up totally falling apart. Um, Remember, everything that happens in the market, okay, if the elephants, meaning the large institutions, are going to end up taking effect, um, it's going to take effect in volume and you're going to end up seeing it. And so I'm going to go through and do my analysis right after this and take a look at it. I will leave you with this. The very first time I ever walked onto the floor of the SIBO, the year was 2001. I was with Tom Sosnoff. A lot of you know Tom. Tom was the founder of Thinkorswim. Um, we were going to see his trading partner because his trading partner hadn't left yet. Okay, to end up working at Thinkorswim, and that was a Sheridan. All right, I think a lot of you guys may remember Scott Sheridan. Okay, he ran the trade desk for a long period of time. And as I looked around, it was about this time of year, a little bit earlier, there were two things that I had noticed. Number one, that there was no news feeds on anything. The only news feed, or the only feed that was coming from outside of the exchange, were the VIX futures. Everything else they were being, telegraphed, meaning on the phone. What they could end up doing on who had handheld computers back then. Not a lot of them, but they were getting all of their information from the E mini futures because it's what ended up driving. the price and how they were going to price everything else. The speed at which it moved meant everything to them because that's what was being driven. And so all I'm saying now is, what, that we should still be doing that to a great extent. Yes, you need to know when large events end up happening. You have to understand, if this, is this selling going to continue? You need to take a look on news days because we are going to be more news driven than ever before. But you can also end up looking at the speed at which things end up moving. Okay, so I'll leave you with that, guys. Thank you very, very much, and I will talk to you on Monday, next Monday.